Well, thank you everybody for attending this virtual event. And yeah, Harry and I have basically looked at the world from a similar vantage point, but we've seen opposite results. And so I'm going to state the case for an inflationary collapse of what is probably the biggest bubble the world has ever seen. The epicenter of this bubble is the United States. And the reason that the bubble emanates from America is that America is the creator of the world's reserve currency. And it's that currency, the dollar, that has enabled this bubble. And even though the bubble has been inflated from the United States, because the US dollar is the reserve currency, the rest of the world has basically, inherited this bubble in order to maintain their relationships of their currencies to the US dollar. Of course, all of this has its start in Bretton Woods. Prior to Bretton Woods, prior to the Second World War, all the nations of the world backed their paper currencies with real money, gold. And so exchange rates were very stable because everybody was tied to gold. Then after the war ended, and of course, the United States emerged as the dominant economic power at the end of the Second World War, and we had almost all of the world's monetary gold in reserves. And of course, the American manufacturing industrial economy was intact. Of course, that wasn't the case in Europe and Japan. So all of the goods, all of the manufactured goods that the world wanted to buy were made in America. And we had all the wealth. America at that time, 1945, we were the world's biggest creditor nation. Americans were so rich, and we generated such massive surpluses in trade that we were able to invest our surpluses all around the world. So we had all of the assets around the world. We were collecting all this income on our overseas investments. And of course, we had almost all the gold. And so what we were able to do was convince the world that rather than being on a gold standard, they could just adopt a US dollar standard. And at the time, the dollar was as good as gold because not only was the US dollar backed by gold, but it was redeemable on demand in gold. So it really was a warehouse receipt for gold. In fact, the dollar was gold. I mean, that was the definition of a dollar. It was a weight of gold. The Federal Reserve note was just a piece of paper that evidenced that you own gold and that it was on deposit at the Federal Reserve. But the reason that the world accepted this was that when each country was holding its own gold, it earned no interest on those gold holdings. The gold just sat there in a vault. But by holding US Federal Reserve notes, countries could then loan those Federal Reserve notes to the US Treasury and earn interest. And of course, back then, the interest rates were quite a bit higher than they are today. And so this enabled foreign central banks to really have their cake and eat it too. They had their gold to back up their currencies, but now because they can invest Federal Reserve notes in US Treasuries, they can earn interest on their gold reserves, something that they weren't doing in the past. All they had to do is trust the US government to make good on its commitments to redeem its IOUs in gold. And of course, that's where the world screwed up, is they trusted the United States. Because once we conned the world into going on the dollar standard, we proceeded to abuse that privilege. And what happened is the US government began to create more liabilities for gold than it actually had gold. And that was great for US politicians because now the US government could run deficits without having to raise taxes and promise all sorts of goodies to voters in exchange for their votes. This, of course, came to a head in the 1970s or early 1970s as a result of the 1960s. That's where we really abused this privilege when we had the big expansion of US government spending. We had the guns and butter policy. We fought the war in Vietnam. We funded a mission to the moon. We fought the war on poverty as these great society programs. We did all sorts of spending, but we didn't raise taxes sufficiently to cover the cost. And so we printed up the difference. And then the world got wise and started to redeem their dollars, their IOUs, for gold, because they realized that there was too much paper and not enough gold. And so the US began to lose its gold. And initially, there was a couple of devaluations of the dollar where we lowered the official price, but the devaluations weren't nearly enough to compensate for how much money had been printed. And so the government had a difficult choice. Either they could have had a substantial devaluation or dramatically cut government spending, which they didn't want to do. Nixon didn't want to do that. So he, basically defaulted on our obligations. And in 1971, we closed the gold window, which was in effect a default. I mean, we had promised to redeem our notes in gold. And then we told the world, we're not going to redeem our notes in anything. You have the notes, you can circulate those notes among yourselves, but we're not going to give you any real money for that paper. It's just a piece of paper. Now, the dollar lost a lot of value during the 1970s. I mean, that's when the price of gold went up from $35 an ounce, where it began the decade, went up to about 800. The US dollar fell precipitously against other major foreign currencies. The dollar used to buy 4 Deutschmarks. It went down to about 1.5. The dollar was buying about 360 Japanese yen. It went down to about 150. The Swiss franc, you could buy a Swiss franc for about 20 cents, 25 cents. It went up to, I think, 75 cents at that time. Of course, it's higher now. So the dollar really got marked down, but it didn't go to zero. And of course, prices went up. I mean, consumer prices went up throughout the United States. Oil in particular, oil went from $3 a barrel to $30 a barrel. Now, it wasn't really oil prices going up. It was the dollar going down, because when oil was $3 a barrel and Americans were buying oil from Saudi Arabia, we were paying in gold. But all of a sudden, we told the Saudis, we're not going to give you any gold for your oil. We're just going to give you these pieces of paper. And so then the oil became more expensive, because now we needed more paper to buy their oil. But by 1980, thanks to Paul Volcker and Ronald Reagan, the big decline in the dollar came to an end, and the rally in gold was capped. And the world continued to operate under the dollar standard, where the dollar was the reserve currency, except it was no longer backed by gold. Now, we never would have been able to con the world into accepting the dollar as the reserve currency if it wasn't backed by gold initially. But by 1981 or then, they were willing to accept the dollar despite the fact that it was backed by nothing. And that was the beginning of the massive global economic imbalances that have produced all the bubbles that we've seen in the US economy, from the dot-com bubble to the housing bubble to the everything bubble that we have now. Americans really raised living beyond their means to an art form. I mean, our whole economy, the whole US economy, the nature of our economy changed because we no longer had to produce anything. We didn't have to have the factories. We didn't have to make all the capital investments. All we needed was a printing press. And if we had a printing press, we could have whatever we wanted. And the rest of the world was content to use their scarce resources, their land, labor, and capital, to manufacture goods for Americans because they wanted our dollars. Even though they were worth nothing intrinsically, just a piece of paper, it was a reserve currency. So that was the trade. We gave the world our paper, and they gave us their stuff. Of course, Americans are on the winning end of this exchange because the paper cost us nothing to create. We print it, we generate it on a computer. But consumer goods require real capital investment, real resources, real labor. And so America went from running big trade surpluses to running huge trade deficits. Today, we run the biggest trade deficits in the world. America is no longer the world's biggest creditor nation, as we were when the dollar became the reserve currency. America is now the world's biggest debtor nation. In fact, the United States owes more money than all of the other debtor nations of the world combined. Right? Now, of course, the whole global economy is replete with malinvestments and misallocations of resources as a result of the excess consumption and profligacy of American consumers. We're out there buying all sorts of stuff, but we're not producing. We're borrowing all kinds of money, and we're not saving. And the U.S. government is now enormous. It has tremendous debts. The funded liability of the United States, the national debt, is about 27 trillion. But that's just the tip of an enormous debt iceberg, because in addition to treasuries, which we're on the hook for, the U.S. government has all sorts of unfunded and contingent liabilities. U.S. government guarantees other debts, mortgage debts, student loans, government guarantees pensions, guarantees bank accounts, mortgages. Then, of course, the U.S. government has all sorts of commitments to retired government workers, to pay pensions, to every American citizen, to pay Social Security benefits, Medicare, Obamacare, but nothing is funded. The U.S. government doesn't have any resources in these so-called government trust funds. All they have is their own IOUs. They've got U.S. treasuries, but those treasuries are worthless. They have to sell them into the market and find a buyer. And at this point, after we had the 2008 financial crisis and the Fed really started to blow up its balance sheet, a lot of people were convinced that this was temporary, that QE was just an emergency measure, and that as soon as the financial crisis was over, the Fed would be able to normalize interest rates and shrink its balance sheet. Of course, I was warning at the time that this was impossible, that it was QE infinity, that the Fed had checked us into a monetary roach motel. Well, then, as the Fed tried to normalize rates, as I said, it wasn't able to succeed. It had to abort the journey. The highest we got rates up to was about 2.5 before the wheels came off the bus in the fourth quarter of 2018. The Fed had to stop the rate hikes on a dime. By early 2019, the Fed was back to quantitative easing, even though they didn't want to admit that that's what they were doing. That was exactly what they were doing. And then came COVID-19, and then we went all the way back to zero, and now the Fed's balance sheet is at 7.2 trillion and rising. But the problem was not the virus. The problem was the fact that we were broke when the virus happened. And then we had to go even deeper into debt to prevent all the defaults and a financial crisis that would have been worse than the one we had in 2008. And I think the reason that the US dollar didn't collapse following QE 1, 2, and 3 is because the Fed was successful in convincing the world that it could reverse policy, that it did have an exit strategy, that it was temporary. That was a lie, but the world believed it. Well, the Fed can't even tell that lie with a straight face anymore. And even if it tried, nobody would believe them. I think everybody now believes that interest rates can never go back to normal because of the abnormal amount of debt. See, the problem isn't the COVID disease, but the COVID cure. All the extra debt and money printing that we had to fight COVID is now a much bigger problem than the COVID itself. And even if we have vaccines that manage to cure this disease, we're not going to cure the economy of what really ails it, which is all the debt and all the money printing. So this is going to continue long after the disease comes to an end. And since I believe that people realize or will realize that there's no end in sight to the money printing and the debt, I think the bottom is going to drop out of the dollar. And, where I agree with Harry is that we're going to see a massive deflation of this bubble, right? All bubbles have to deflate. The air is going to come out. But the reality is we're living in a fiat world. This is not the 1930s. The dollar is not backed by anything. The dollar is not gold. And so what the U.S. government is going to do to keep the air from coming out of the stock market bubble, the real estate bubble, to maintain the illusion of a sound economy and to facilitate U.S. government spending. Because the government can only spend if it can borrow. And the only lender is the Fed. Because the world now no longer wants to lend the U.S. government money at a rate that the U.S. government can afford to pay. There's so much debt now that rates have to be zero. In fact, in many cases, zero is too high. You have a lot of calls for negative rates. But the only entity dumb enough to loan money to the U.S. Treasury at such a low rate is the Federal Reserve, because it just creates the money out of thin air. It doesn't have to work hard to get the money, right? It just creates it. So it doesn't matter. So it's willing to buy U.S. Treasuries. But as the world realizes that the Fed has gone from the lender of last resort to the lender of only resort, the bottom drops out of the dollar. And so the government is willing to sacrifice the U.S. dollar in order to prop up all these bubbles and in order to allow the US government to continue to spend money. So if you want to measure assets, if you want to take a look at real estate prices, if you want to look at stock prices, bond prices, all prices are going to collapse if you want to measure them in terms of real money, that real money being gold. So if, a stock is, you can buy a stock for a tenth of an ounce of gold, if that's how much a share costs, well, maybe you'll be able to buy that same share for a hundredth of an ounce of gold, right? You can see a 90% decline in the value of US stocks priced in gold. I mean, we've had that before. We had that type of decline in the 1930s. And in fact, we had that type of decline during the 1970s, measured in gold. Now, the 1970s, we had all this inflation because we were no longer on the gold standard. So you didn't see that type of decline nominally, but measured in gold prices, that's exactly what you saw. And I think we're going to see the same type of decline again because the United States is in far worse shape economically now than it was in 1970. And so this bubble is far bigger, and you have to have a much bigger adjustment. In fact, what I think is going to happen to gold is that I think gold is going to end up being remonetized. I think as we have a loss of confidence worldwide in this fiat system, because all the currencies that are backed by the dollar are also going to be in trouble when their backing is collapsing. I mean, if your currency is backed by the dollar and the dollar is backed by nothing, and now the confidence has been lost in the dollar, then there's nothing backing up these other currencies. So I think just the way the world, or the US rather, led the world off the gold standard and got the world to adopt the dollar standard, the world is going to reject the dollar and return to gold. And once again, gold is going to be the primary reserve for all the world's currencies. And that's going to be a big monetary reset. And I think that the country that has the most to lose from this transition is the United States, because the United States gained the most from the dollar being the reserve currency. We got to live beyond our means, and we have an economy, a service sector economy, that can only survive so long as the dollar is the reserve currency. But once Americans now have to abide by the same rules as everybody else, once Americans have to produce if they want to consume, once they have to save if they want to borrow, it's a whole new ball game. But there are going to be changes throughout the world. I mean, this is going to have ripple effects. There's going to be winners and losers in every country. The key as an investor is to understand what this means, how asset prices will change relative to one another. And so you need to know which assets to own and which assets to avoid. And again, if I'm right on the inflationary nature of this collapse, where it's the currencies that collapse in value, not the real assets, although the real value of those assets priced in gold is going to go down, priced in dollars or other currencies, that's not going to happen. So what you don't want to be is a creditor, because inflation wipes out creditors. Not only is it a tax that governments impose surreptitiously on the population, right? Rather than taking their money through a legitimate tax, governments just create money out of thin air and spend it. And so they're robbing the citizens of their purchasing power. But when they do that, they also wipe out debt. And of course, the biggest debtors on the planet are governments. The biggest government debtor is the United States, which is one of the reasons why it creates so much inflation, is it's the only way to pretend to repay the debt, because actually repaying it is impossible. Defaulting is not politically viable. So there's only one alternative. If you can't pay your debts and you don't have the guts or the honesty to default on your debts, well, then you have your central bank inflate them away. And that's what's going to happen. But that means all the debts denominated in that currency get inflated away, no matter who's the lender and who's the borrower. So you don't want to be in paper. You don't want to be a creditor. You want to own real assets. You want to own real things, like you want to own gold, or you want to own property. You want to own shares of companies. But it's not all going to be equal. Some property is going to do much better than other property. Some stocks are going to do much better in the economic environment that's coming. So you have to understand where in the world you want to invest, which particular currencies you want to own, what sectors do you want to invest in, what stocks within those sectors, and the various commodities that you want to own.